Welcome back. Let's get you all the business news now. Equity benchmarks opened volatile and declined through the day. HDFC Twins, auto and media sectors dragged the market lower. PSU banks and IT were the only sectors trading higher. Neeraj Shah with the wrap of all the market action today.
Well, thanks for that. Indian markets have enjoyed consistent strength the last few days, so today's a bit of an anomaly, but maybe a much necessary kind of a pullback, because market shouldn't be up almost every single day. Today the banks led the corrective move, no doubt, but if you just look at the market-wide behavior, declines more than advances, and the Sensex and the Nifty down over 0.5%. Now, key amongst this was that the two heavyweights, HDFC Bank, they went ex-dividend, as a result of which they were trading lower. But aside of that, a bunch of other stocks in the heavyweight segment, or heavyweight category, if you will. Reliance Industries was down in the session today. There was weakness in Kotak Bank. There was weakness in Maruti yet again. Mahindra & Mahindra was looking weak. So a bunch of stocks that went down today. Not too many gainers again. That was the other point. Even at the broader end of the spectrum, yes, you had a bunch of gainers, but the losers stood out. Zensar Tech was up 12-13% yesterday. That stock was down 8% today. So it's a bit of a yo-yo that stock is playing. The Adani Group stocks, Total Gas and some of the others looked weak in the session yet again. There was weakness in JM Financial. There was a results reaction seen in Asahi, India Glass and a few others. So that combination of news flow plus the general market weakness weighed in on a bunch of stocks. But as is the norm, and not always loses some gainers as well. At the broader end of the spectrum, we had Vesuvius India reacting to results. Good show, did well. Repro and Madhukela bought in some stake, and that stock was up 14% after being up 20% yesterday. Midani, Sonata Software, strong commentary from the company, and that stock too did well. So net select bottom-up movers, but on slightly lower volumes than usual, the markets look slightly weak. Let's see how the week ahead shapes up. Back to you.
Thanks for that. Now, shares of HDFC Bank and HDFC dragged the markets after the companies were trading ex-dividend today. HDFC has announced a 1900% dividend, while HDFC Bank has said it will pay a dividend of a whopping 2200% for financial year 23. Dividend will be paid on the 1st of June. Jasprit Kalra gets us the details.
Shares of both HDFC Bank and HDFC Limited were down in the red today as both equities started trading ex-dividend. What does that mean? Simply put, dividends are payments that companies make to their shareholders as a reward. Around these dividends themselves, companies set a record date, and it is in and around those record dates that equities adjust to the amount of the dividend that has been paid out. HDFC Bank, for its part, put out a dividend recommendation of ₹19 per equity share, and HDFC Limited similarly had a dividend recommendation of ₹44 per equity share that is to be paid out to shareholders. It is important to note that both of these lenders had set May 16th as the record date for their respective dividends, which is why we're seeing movement in the equity prices today on the markets as well. Also important to note that if you're an investor in these equities that pay out dividends, just HDFC Bank or HDFC Limited, you need to have the shares in your demat account on or before the record date itself. If you purchase shares on or after the record date itself, you will not be eligible to get a dividend payment. Earlier, in April, HDFC Bank reported strong quarterly results, with its profit rising 20%. HDFC Limited also reported strong quarterly results earlier in May, with its profit also rising by about 20% year on year.
Now, PVR Inox has slipped in trade today after a flow show of in quarter 4. The company slipped into losses in the 4th quarter and has decided to shut 50 loss-making screens over the next 6 months. Underperformance of Hindi movies and lesser number of Hollywood releases marred the industry. BQ Prime's Sajid Mangat spoke to Nitin Sood of PVR Inox.
I think we were shut for almost 18 months during the pandemic. And obviously the OTT platforms, etc., took a lot of content to consumer homes when people were stuck at their houses. As a result of which, what has also happened during the last 12 months is most of the content that got released on big screens was conceptualized and created pre-pandemic. You saw, while the regional content continued to be accepted by the audiences, a lot of Hindi films did end up underperforming, and the box office of Hindi films was almost 30% below where it was pre-pandemic. Similarly, Hollywood films had almost 40% less film releases last year because not many films were shot during the pandemic. So both these situations are correcting very fast. This year, Hollywood film releases are almost up by 30% over what they were last year. And we are seeing some big tentpoles releasing this year. US box office is looking very promising. And a lot of Hindi films that you will see now releasing, May, June onwards will all have been created and conceptualized, post-pandemic. So you will see a refresh button in the content, that hopefully comes out for release this year. And we are headed in the right direction. So looking forward to, Q2, Q3, Q4 being promising on back of a lot of good content.
Pizza Hut and KFC India operator Sapphire Foods' performance in Q4 was below street expectations. Revenue and PAT jumped, but EBITDA declined. KFC India's revenue grew 24%. Pizza Hut's revenue too was up 18%. Higher inflation in dairy impacted gross margin, and the management expects the demand to remain soft. BQ Prime's Sajid Mangat spoke to Sapphire Foods' Sanjay Purohit.
The pressure will continue for the next 2 or 3 quarters. Inflation and the impact of double-digit pricing always takes a little time to bake and therefore revive. However, we are not keeping quiet, and we are not, being victims of what is happening in the, in the general economy. I think we are going front foot in the spirit of the IPL. We're going there front foot and trying to hit the ball out of the park. So we've got a strong marketing, product innovation, advertising program on both the brands. On KFC, like I said, we've launched chicken rolls. We are so excited with this launch at 99 and 149. The product is absolutely outstanding and is flying. On Pizza Hut, we've revamped our core menu apart from Flavor Fun, which continues to do well. So 10 new pizzas, new sides, new appetizers. And first time we've come on television also, Sajid. So I think we are saying that we are in control of our own destiny. And if we put our best foot forward, that here is an opportunity in a market where demand is perhaps a little constrained, because consumers tend to revert back to their most trusted brands. And therefore, KFC and Pizza Hut, such great equity with consumers. I think this is a good time for brands like us, to put the best version of ourselves in the market, and then I'm sure consumers will reward that.
Now, valuations of Indian startups are crumbling. While the companies had enjoyed good valuations in 2021-22, the access to capital has become tighter now. Rishabh Bhatnagar with the details.
At least 4 leading Indian startups have seen their valuations tumble over the past 12 months. These startups include Byju's, Ola, Swiggy, and Farmeezy. Now, these valuation drawdowns have been made by US-based investors in their own books. These investors typically hold minority stakes in these companies, and they've made these changes public via SEC filings. Now, the main reason why these valuation drawdowns are happening is because in 2021 and the first half of 2022, access to capital was easier, and hence startups raised large sums of money at lofty valuations. Today, however, access to capital has become tighter with rising interest rates, and so priority for funding is being given to companies that are leaner, have demonstrated proven paths to profitability, and are past the cash burn stage. This is also why companies have been laying off employees, and why salary hikes this year might not be great at startups, as they're looking to cut expenses. In fact, a recent report by Innovin Capital mentioned that about 55% early-stage investors said startups were overvalued in 2022. So these spate of corrections that we've been seeing in the valuations of startups might continue, and in the future there's a possibility of down rounds for these startups.
Big tech companies across the globe have been laying off employees amid worsening macroeconomic conditions, and now e-commerce giant Amazon has laid off 500 employees in India. This is a part of the worldwide job cut. Sakshi Bajaj joins us with the details.
Amazon India is laying off around 500 employees. NDTV has learned that the process of layoffs is ongoing and employees from Amazon Web Services, human resources and support functions are being laid off. The layoffs are part of the 9,000 jobs cut announcement that was made in March 2023. Remember, in March, Amazon had revealed its plans to cut around 9,000 jobs from its cloud services and advertising divisions on back of recession fears. Amazon has also said that the decision for these layoffs has been taken to streamline costs and headcount on back of global economic uncertainty. Sources have told NDTV that some of these employees are part of global teams working out of India. However, it is important to remember that the reasons for these layoffs remain the same as for many other tech giants, that of overhiring and higher expectations for IT solutions during the pandemic, and now the reality on the ground for this sector looking very different, with some of these roles being completely redundant altogether.
All right, and with that, it's a wrap of all the business news.